Hey, everybody, thanks again for joining us tonight. We're really excited to talk about Jasper Point Plaza. This is our new retail center that we're buying in the Des Moines, Iowa market. As we'll talk about in a little bit, we like the Des Moines market quite a bit. We've got a few other assets there, and they've been performing well for us so far. So just jumping in a little bit, a couple ground rules and reminders. First, this is a private placement offering, which means we'll be filing with the SEC and selling shares of ownership in this project. So with that, some of the regulations are that we have to have prior existing relationships with all investors in this project. So if you have friends and family you want to refer, please do, but please make sure you work through us as well, because we want to make sure we get to know them and help make sure we're all working together to achieve the same investment goals. Quick agenda and friendly reminders on just kind of housekeeping. So we are using Zoom webinar feature. So it actually has a Q&A box at the bottom of your screen. If you have any questions, just type them in there. That makes it really easy for us to keep track and respond via text in that chat, as well as type up those responses, and we'll share them all tomorrow. So that just makes it a little easier to facilitate that. So tomorrow you'll have a summary of tonight's webinar, you'll have the recording, and you'll have the full deck. For our agenda, we're going to jump in first and kind of give a quick overview of who we are with Suncrest. We also have Alpesh, who's going to be joining us, who is joining us from Wealth Matters, and he's going to be one of the partners on this deal too. So we'll kind of talk about our background together, get right into the investment, the project, talk about the property, overall market. In this case specifically, I think a fair amount of us are a little bit nervous about retail, just given COVID environment. So we're going to be talking a little bit about why that we think now is the perfect time to be getting into retail, and then our business plan, what we're going to do with this project to really add some value. So first, introducing myself. So I am the Chief Investment Officer for Suncrest. So I'm primarily responsible for all of the underwriting, performas, any of the financials, bookkeeping, taxes, all that kind of fun stuff. I also do all of the legal work just to make sure that we're doing everything correctly. I have liability protection from an entity structure standpoint. I've been doing real estate investing for a little over 12 years now. I've done multifamily, industrial, mobile home parks, and retail. So really looking forward to jumping into this project in particular. Ryan, you want to introduce yourself?
Yep. Thanks for joining, everyone. I am co-founder and chief operating officer of Suncrest. And my real estate background, I was 13 years as a residential real estate agent before jumping over the commercial side. So I am on the operations side of our multifamily, mostly mobile home parks. And on this specific deal, my focus has been on performing lease audits, diving into the details of all of the leases and assisting with tenant negotiations.
Great. Thanks, Ryan. Matt?
Hi, everyone. Thanks for attending. My name is Matt Hall. I've been investing in real estate for a little over 15 years now. I'd say my early investing was mainly in single family and condos on the East Coast of the United States. And over the past couple of years, I've been investing with Brett and Ryan, mainly focused on mobile home communities, which I think Ryan is going to talk about in a couple minutes. I work with Brett on a lot of the underwriting for essentially all of the deals that we work on. And I also work with Ryan on the asset management for our properties.
Alpesh?
Alpesh, you can go.
Thank you, everyone, for attending. My name is Alpesh Parmar, and I've been investing in real estate for about 11 years. Pretty much I started as well with single family to multifamily, and I'm also focused pretty much in mobile home parks and senior housing facilities. I've been in trying to work with Brett and partner on a lot of their deals. So I'm looking forward to this particular deal where we'll be tackle a retail or a shopping center in a market Suncrest has been operating for some time. So I'll be handling the project management side of this deal, pretty much looking at, because once we go through the deal, you will see we are also thinking of adding an 8th unit. So I'll be focusing on that. And of course, converting the tenants to triple net lease. Thank you, Brett.
Yep. Thanks, Alpesh. So Ryan's going to talk to you a little bit more about Suncrest and who we are.
All right. So as you can see, most of our properties are in the Midwest, and we'll focus mainly on the Des Moines market there. So Jasper Point is in Newton, Iowa, where we also own a mobile home park just a few minutes away called Country Creek Estates. So we've been in the market for a number of months there, and our property manager just lives a short drive away that will be helping with this project. So this is an up and coming market. The population is growing here, and a lot of new construction is happening. So we're excited for the location of where this is at, and then Alpesh will get into that a little bit more soon. But very happy with growing in this specific market in Newton, Iowa. I feel it's important to let you know about our experience with the Scott Shields Commercial Real Estate Academy. So just a little bit about Scott. He's an entrepreneur. He's founded multiple national businesses. He's on like national television talking about commercial real estate as well. And he founded the Commercial Real Estate Academy about 20 years ago. So we're in our second year as members with the Academy. So through that, we've received thorough training and education in the retail space. And we've also vetted this deal through Scott himself and two other members of the Academy who have extensive retail holdings. So feedback has been very positive, and it's been reassuring to see that and hear that from our mentors on our assumptions for really this is a nice, stable, and profitable investment for everyone. Also important to note that as a company, we are Verivest certified or verified. So Verivest puts sponsors through due diligence process, ongoing portfolio monitoring. Principals also agree to quarterly to adhere to their code of conduct. So we've been vetted and verified through Verivest, just adding an additional level of confidence for our investors.
Okay, great. Thanks, Ryan. I'm gonna go over some of the investment highlights. We have a bunch here, and I'm gonna briefly kind of just go over each one. We're going to be offering a 8% preferred return for this investment. And that simply means that this is the minimum return that a limited partner will receive before any of the partners in this deal would receive any type of payment. We're expecting a 2x equity multiple over a 5-year hold period. Although I would say we're still evaluating the potential of a refi. And at that point, what we would do is we return all of the investor equity and then potentially hold on to it for a slightly longer period. In terms of the property, we're starting, and it's 100% occupied right now, which is really great for the cash flow right off the bat. And this property has 7 retail stores in it, and I would say most of them, or I'd say they are internet resistant. And we also have the ability to add on to this property. So whereas Alpesh had kind of mentioned during his bio, and we're still evaluating that at the current moment. We will be doing a cost segregation analysis on this property. And by doing that, we're going to be able to accelerate the depreciation and provide that bonus depreciation to all of you to kind of offset your taxes on your investment income. And I also want to mention that we're putting skin into the game as well. The partners on this deal are going to be putting in at least 25% of the capitals investing in LP. And we're only going to be raising around $700,000 for this deal. So we really expect our raise period to end quite soon. As Ryan kind of mentioned, we are familiar with the area. We own a mobile home park in just in the north end of town. So we're quite familiar with this area, and we're obviously going to be able to leverage resources to efficiently manage the property as well. Next slide.
I'll pass you there. Your audio
Yeah, so
perfect. Thanks.
So yeah, sorry. Thank you, Brett. So this is how the property, the current owner, when he acquired the property, this is how it looked, right? So some of the signs were outdated, old. They also replaced the monument signs. So Brett, can you go to the next slide?
Yep.
Yeah, this is how the current signage look. As you can tell, bright colors. They look brand new. So just to give you guys an idea about the property, overall the tenant structure, there are 7 tenants, as Matt mentioned. The first and the biggest one is Goodwill. It's a non-profit organization. It has been around for a long time. It has been in this location for 11 years, right? So Goodwill's business model has proven resilient through varying economic conditions. Most of the people prefer to go to the brick and mortar Goodwill store, right? We did our research, and it seemed about 5% of their revenue comes from the internet or the .com site. The other one I want to mention is the biggest foot traffic or the car traffic, which brings is the Scooters Coffee drive-through, which is pretty famous. Of course, living in Bay Area or in Idaho, we may not know about it, but it's pretty famous in Midwest. They have had about 150 stores already. It's a drive-through chain which started back in 1998. So it's been around for a while. And they just started at this location, and they are very committed. Actually, that they have been successful because of the great location. That's what they find: high quality service and high quality products. So they think this is one of the best location in that particular area for scooters. The third tenant we have is Advance America Cash Advance. It's like a payday loan. They have been around in business over 23 years, and they have been at this location since 1989. So it's Advance America has worked to become one of the nation's leading providers of consumer financial services with over 1,200 locations nationwide. So I think they are here to stay. Then there is a restaurant, Sombreros. It's a local favorite, operating at this location for over 10 years now. And even during COVID, when we did the tenant interviews, they didn't suffer much. They said that they were not affected much by COVID. This particular tenant has extended its space by adding outdoor patio setting, showing a capital commitment to our location. The fifth one is Number One Nails. It's a local hotspot for nails and salon. It's been operating in the location for over 10 years, and they've been operating pretty successfully. The sixth one is China King. It's a Chinese well-known restaurant. They have been just at this location for over 20 years. They haven't had any issues because of COVID. And the last but not the least is the Vape Shop. It's a newest entrant to this center. They just started actually last year. And they've been operating successfully to meet the need in the city. Future predictions for web shops in the country include more demand and growth of 23+% in the next 5 years. When we looked at this shop, it was very clean, spacious, very well-maintained shop.
Right, and I was just going to point out that China King sign is actually, that's been replaced too.
Yes.
So this is the newer China that just came up a couple weeks ago. They installed that.
Thank you, Brian. And we can talk about so this is how the property looks. It's at a major interaction, crazy amount of traffic, about 11,939 vehicles. And then on the cross street is around 3,600 vehicles per day. It's right next to O'Reilly. So that's another good thing. It's also opposite of Walgreens and Subway. So there is a lot of traffic. So I think it's a win-win. we can. And so here is what why we are looking at this particular deal. When we talk about, let's say, mobile home park to senior housing to apartment buildings, the traditional real estate works this way, where you have income and then you have expenses, right? All kind of expenses, property management to maintenance to insurance to all that. And after removing or subtracting the expenses, we get NOI or net operating income. And then from there, we pay, we take care of the debt service, the principal and the interest payment to the mortgage company. And then what is left is the cash flow. That's how the traditional real estate works. The retail centers or sometimes it's called single tenant triple net lease. We have 7 tenants. We can basically convert them to triple net or NNN lease, where the way it works is that we have the income, we subtract the expenses, and we get paid for the triple net reimbursements. And what I mean by that, triple net is that triple net includes the property taxes, real estate taxes, all the expenses, building insurance, and maintenance. So all of those expenses would also be paid by the tenants, right? So pretty much triple net leases are a hot favorite for a lot of senior citizens, retirees, life insurance companies, because they don't have to put any kind of work, right? Whatever you get, the income you are getting after paying all the expenses is your net operating income, right? And in this case, all the expenses would be paid by the tenants. Again, we are not there yet. That is our goal. We want to try to convert this property to absolute triple net. If that's not possible, we'll try to get to at least 90% triple net. So that way, most of our expenses are reimbursed by the tenants.
Thanks, Alpesh. And so I'll just reiterate that because it's not triple net today, that actually is a major part of the upside for this project, is converting it to triple net. And most tenants realize that triple net's the standard. So it's obviously not an easy conversion, but it's at least something that the tenants are used to. Matt, oh, sorry, go ahead.
So sorry, and triple net definitely increases our NOI and reduces a lot of our management cost as well. Sorry, Brad.
No, you're great. Thanks. Okay, so jumping down to market from Matt.
Okay, so when we talk about the market, really what I wanted to touch on, and Brett alluded to this when he started out, is I want to touch on the commercial retail market. I'm sure many of you guys might be saying to yourselves, you guys want us to invest in a retail center? Everything's being sold online now. Didn't COVID decimate retail? I thought that retail is dead. Obviously, nobody has a crystal ball, but what we can clearly see is that vacancy in commercial retail is starting to recover following the pandemic. This graph that we have here on the right, it details the vacancy rates for suburban retail as well as central business district retail. And you can see that from 2014 to really the start of the pandemic, vacancy of retail had been decreasing. And during this time, the vacancy rates of suburban retail has been higher than central business district retail. With the onset of COVID in 2020, we recognized that, and we've kind of all seen driving around, that vacancy rates of retail had increased across the board. But it's starting to recover now, as you can see the graph kind of trending down towards 2022. And the interesting thing is that the vacancy rates of suburban retail has dropped below central business district retail. And that's for the first time since about 2007. And why is this? Why is that happening? It's because people are shopping where they are. And right now that's at home. People are working from home. They're going locally to get coffee, food, and kind of any other services that require. I think that we know that people are starting to move to the suburbs. They're migrating out of bigger cities. Bigger cities are starting to see drops in tourism and other foot traffic. In addition, they're just simply, they're not working in these larger cities anymore. think another trend to also kind of keep in mind, that larger brands are also starting to invest in suburban areas. Brands like Starbucks are moving closer, or closing locations in central business districts, and starting to go into locations in more suburban areas. I can also kind of provide another anecdotal piece of information that makes us feel really confident about retail in Newton, is the information that we're hearing from people that work from the city of Newton. We've worked with city officials, Matt Muckler from Newton, and he's talked about the desire for more retail, and he's currently talking to us about larger projects, both land and buildings that are available. And simply kind of put, the city of Newton just simply has a demand for more retail. I think the last thing that I'd want to mention is that the businesses that are in this Jasper Point shopping center are pretty internet resistant. They won't necessarily have to close because Amazon or other internet giants are going to come take their business. We have restaurants in the shopping center. We have services like nails, things that you can't do, they can't do over the internet. I would say the only kind of unique establishment is Goodwill. And they do have a small online presence. However, less than 5% of the goods that are donated to Goodwill are sold online. And really, most shopping at Goodwill is done in the brick and mortar establishments, so people can find those unique treasures.
Matt, I may add on a little more to the anecdotal piece. So the city officials, our park managers that we've known for a while now, they say that this center has never looked better, with what has been able to happen even before closing, and two, the shops in there are well regarded, especially the restaurants. They're known to the locals as like two local favorites or hotspots. So it's popular and well known within the community.
Thanks, Ryan.
Great. Okay. Sorry, I'm just flashing the deck real quick. Okay, so jumping into the business plan, this is my favorite part. Well, obviously the returns are really my favorite part, but talking about how we get there is my second favorite part, I should say. So prior to closing, this was one of the reasons we liked this project. We negotiated with the seller to make a bunch of improvements before we even closed. So he completely redid the facade. Honestly, on all of these projects we look at that are in the 1970s vintage, they need new facades. So we generally budget a lot of money, $100,000 to $200,000 just for facade work on some of these retail centers. And that can sometimes kill a project. So having that done before we even close has been massive. So as Alpesh mentioned, he has new monument signs for China, King, and Goodwill. Both went up. The rest of the signs already looked okay, or good, I should say. We've been working on tenant interviews. So what's cool about retail is you can actually interview the tenants ahead of time, understand what concerns they have, what they like, what they don't like, and get a feel for what leverage you have going in and renegotiating leases. So as Alpesh explained, a big part of the strategy here is, first, we need to renew leases to make them longer, to make sure we have that stability. And that actually improves your value. It's not just about your cash flow, it's also about the risk, right? And the longer your tenants are signed for, your lower your risk, which inherently improves your value just by increasing the length of the leases. The second is the triple net aspect. So once we convert our tenants to triple net, that's just $1.16 per square foot for them, but that ends up adding so much more to the bottom line net operating income that the overall value jumps a lot. So doing that within the first couple of years is our plan. And in fact, we have a Sombrero already that we know exactly what they want. They're willing to renew. They're willing to go to triple net. All of those things that before even closing, having that kind of information is pretty crucial. So year one, we'll convert tenants to triple net. We'll also be renewing leases to make them all 5 to 10 years out. We do have some that are more than a few years, but many of them will renew over the next 3 to 4. So extending that's going to be big. And then finally, I don't know that we really touched on this a ton during this webinar, but we have talked about it in some of our emails. There's 7 units now. And I'll just bump back actually as part of this discussion. I'll come back to this panoramic. On this 8th side, this picture doesn't really show it very well, but there's actually a loading dock that's not being used. And so we have the ability to add an 8th unit right there. We're currently getting bids for this. If the bids come back at the right number, we will add that to our business plan. So currently, even though I have it here, it's not actually part of our underwriting. It will just basically sweeten the deal because we'll be able to add an 8th unit. We'll be able to make a massive improvement to the NOI. All those things will be great. And the bank we're working with is a credit union. We've done 5 projects with, all in Iowa. So this is the 6th project we've done with the same bank. And they've agreed to give us an 80% line of credit once we have the letter of intent from a new tenant and we're ready to construct. So they'll be funding 80% of that construction. Again, we don't have that as part of today's business plan because it's so fluid and we've got to make sure we've got the right solid plan. So that'll be something, again, it'll sweeten the deal, make it a little bit more of the icing on the cake. The next 2 slides are more tactical. They're just kind of describing the structure. So we have on the left side the partnership structure. So the main fees we have in this project are 2% acquisition fee. So this fee covers a lot of the risk and the time involvement that we have in the project. It also helps pay for salaries for some of our centralized team. We have a few full-time employees that from these fees, that's how we pay our salaries to them. So 2% acquisition fee, and then we also have an asset management fee that's 5% of the gross income. What's interesting about this project in particular is that we will not only be the asset managers, but largely the property managers. As Ryan mentioned, we have a team on the ground in Des Moines that are already managing other assets for us. Matt, Ryan, and I will be also the primary property managers for this property, and then we'll have them on site as needed. So we'll be trying to reduce the cost of true property management as much as possible by us having centralized a lot of that. The other aspect of the asset management fee is this is a non-operating expense. So this is actually below net operating income, so it doesn't impact NOI. And it's truly just about optimizing the performance of the asset. Preferred return, this means that before any cash flow is distributed, all of our investors, including us, because as Matt explained, we're going to be investing 20% ourselves. So from a limited partnership perspective, we return 8% cash flow first, and then anything above that is split. So the splits on this project are quite generous. So we're doing 80% of the split above 8% will go to investors and 20% will come to sponsors. So essentially what that means, if you're new to partnership structures like this, is if we have 10% operating cash flow in a year, the first 8% of that cash flow will go straight to investors, and that's an 8% return. The remaining 2% is split 80-20. So the additional 80% of that 2%, which ends up being 1.6, hopefully that math is correct in my head, will go to investors. So that'd be a 9.6 return, and then 0.4% of that would come to sponsors. And then once we achieve a 20% return, then that split gets more aggressive at 50-50. The reason we do that is it really incentivizes us to overperform or outperform our projections and get to that 20% mark and get investors even better returns than what we projected. On the right side, this is just a structure example. If you invest 100,000, price per share is $1, so you would have 100,000 shares in the project, and then you would add that this percent. Sorry, this is actually a mistake. I'll correct this for tomorrow's deck, but I believe 100,000 would actually end up owning about 18% of the project. And then we'll be doing monthly preferred returns. This will start 6 months after acquisition. So we're looking to close in the next couple of months. We currently are planning to close April 11th. There's a slight chance we'll push that, and we'll notify everybody that has reserved an investment amount first. We have the flexibility to push this out a month, but again, we're shooting for April 11th just per some of the negotiations we've made with the seller. A lot of the reason we were able to get some of our purchase price and rehab and everything like that up front was because we were willing to close quickly. So stay tuned up for a little bit more information on that. We're planning to hold this for 5 years. Really after 3 years, we'll have fully optimized the project. We'll take a couple of years to enjoy the cash flow and then exit at year 5 so that we're kind of that's kind of the optimal timing to take advantage of the returns on this project. And then finally, we're projecting through a cost segregation study of this project that we'll be able to provide investors with a 60% tax deduction year one. So in this example, if you invested 100,000, we're expecting to have a write-off in year one of 60,000 on that. This is through bonus depreciation that came from the 2017 Jobs Act. I can jump into this a little bit more detail if there are any questions about this at the end of the webinar. But definitely one of the best parts about investing in real estate is some of the losses you can take on taxes. Finally, this is our budget. So on the left side, we are taking on about 1.5 million in debt and then 700,000 in equity. So the equity is from our investment partners. And as Matt said, I really expect that to go very quickly. We're actually about half raised already just from people prior to even having the webinar, having already made commitments. On the right side, purchase price is 1.8, and then financing costs. A lot of these are estimates because we don't really know until we're about a week or two out from closing, but we always overestimate these. And then any overage just immediately comes into as extra reserves. So financing costs is purely the lender costs like closing fees, origination fees, things like that. Due diligence third-party reports is our cost. So if we have any travel or if we have to pay for somebody to do legal work, mostly in this project, it's legal work. We've had a professional inspection done and a few other things like that that'll come out of that 18. And then again, I mentioned this acquisition and loan guarantee fee. We sign on the loan personally, so we're guaranteeing it. And that's just extra risk, extra time. Obviously employee salaries that I mentioned before. So this 36,700 is based on the 2% acquisition fee that I mentioned before. And then operating reserves, this is really just, you know, we want to make sure we have some money in the bank for things you don't know are going to happen. Maybe a tenant's late paying rent, or we've got to fix something we weren't expecting. That's just strong reserves. And then tenant improvements, this is for the capital improvements to the center that are specific to tenants. So in retail, there's sort of this negotiation build out where you have a new nail salon like we do now. They come in and they're generally responsible for most of the work that goes on there. So they bring in their own custom sinks, custom salon beds, custom whatever, right? Custom lights. And a lot of that, what's really cool about it is it makes it so that they're so invested in the property that they're likely not to move. At the same token, though, there's sort of a give and take with the landlord, because we can negotiate that maybe we'll pay for some of those if they convert to triple net or if they agree to increase rents to market rents. And some of these tenants are well below market rents. Market rents here are about $10 a square foot. We have a couple that are around 6 or less. So lots of opportunity to increase rents, lots of opportunity to increase and add triple nets. And the tenant improvements is sort of our leverage to negotiate that. This final slide is the timeline. So the way this works is this is how, when you're joining this partnership with us, what the steps are to join. So first, watch the webinar. Congrats, you've all done that. Second, reservations are due via Syndication Pro portal. So Syndication Pro is our investment management software. You can access it by just going to suncrestcap.com. This is our website. Up in the top right, you'll see a link that says invest. Ali tomorrow will send out an email with all of these notes, and it'll also have that website directly on it. Second, we have the funding deadline is April 8th so that we can close April 11th. This is generally, we like to have a 2 to 3 week gap between funding deadline and closing. In this case, it's a little tighter, and that's largely because we've already pre-funded so much of this. We can close without the rest of the funding. So it's a little tight, but that's why we're doing that. And this timeline overall is very compressed. Generally, we have 90 days to close on a deal. In this case, we've had 45. And again, that's part of the reason we got the lower purchase price. Part of the reason we've got a lot of the CapEx done up front is because we were willing to close quickly. And then once you're in the investor portal, you will see a few steps here that it'll be a workflow. You'll even see a timeline in there that tells you what your steps are. The biggest one is signing the legal documents, the PPM and operating agreement, which you'll see, and you'll just do an e-sign on that signature, and then you'll wire your investment over, and you'll see the instructions right there. And then you get to enjoy the monthly cash flow after 6 months, which is always exciting, of course. So with that, I know I went through my section in particular very quickly, but what questions do we have so far?
I don't see anything in the Q&A yet, Brett, but.
Okay. Well, while we're waiting, I will tease up a few questions that we generally get asked. So we have a FAQ section. So just kind of going through those while we wait for full Q&A to come through. But first one that we generally get asked is can I do a 1031 exchange with this? So 1031 exchange is essentially a tax code. I was going to say loophole, but it's not really a loophole. It's the tax code that allows someone to trade an asset, essentially, where they sell one real estate asset and buy into another one. Generally, we do support those. However, it takes a couple months to structure one of those. And so in this case, that's not going to work out for this deal. If you're in a 1031 scenario, please contact me directly. This is my email address, and we can work on one of our other deals that we can support that on. Any risks coming in as a limited partner. So the term limited partner refers to the risk specifically. Your risk is purely limited to the investment you make. So if you invest $100,000, the worst case scenario ever that could happen is you won't get your $100,000 back. Obviously, that's not going to happen because we're going to kill it and work really hard and make sure that this project is extra successful. But that's your total risk. As a general partner, we take on a lot more risk. And that's part of the reason why we have some of those sponsor fees and asset management fees. But we personally guarantee the loan. In this case, the loan we're doing is a full recourse loan. We're also taking on just extra liability of potential lawsuits. So of course, we structure our entities in a way, and we've got insurance, all those things to be protected. But that's just that extra risk. What will the debt be used for? So in this particular situation, the debt we're taking up front is 100% for the property. It won't be used for any capital improvements yet. So any capital improvements we make so far will come out of that $700,000 equity budget. But if we do add that eighth end unit, we'll be taking on another small line of credit to do that, which would be 80%. Can I invest through a retirement plan? The answer is most likely yes in this case. And again, generally I say yes, absolutely. In this case, it's a little bit of a tight timeline. So please email me directly and we can figure out in your situation if we can make that work for just kind of the logistics and timing. Tax benefits, I got into this a little bit with when I talked about the business plan, but there's a ton of benefits of investing in real estate. The biggest one is, in my mind, the depreciation benefit. So in a normal situation, you can depreciate really any real estate asset. So the most common is somebody will buy a single family home and rent it out. So in this scenario, just to compare apples to apples, if you paid $100,000 for a single family home, including like your loan or whatever, if the total purchase price was $100,000, you can depreciate that over 27.5 years. So you would take a $100,000 cost basis and divide it by 27.5 years. And then every year on your tax return, you get to claim a loss equal to that 27.5 division there. With commercial real estate, you get this cool thing called bonus depreciation. And technically you can do it in single family homes. It's just generally not really worth it. But with bonus depreciation, you do something similar where you say, okay, we paid $1 million for this property, and you divide it over a similar schedule of 27.5 years. But we can do what's called a cost segregation study, where we actually have an engineering firm and accounting firm come in and they assess all of the materials that went into this building. So they look at vinyl versus wood versus carpet. All those things are depreciated differently, and they put everything on a different schedule. So some things might be over 15 years, some things might be over 5 years, some things over 27.5. And then what's really cool about the 2017 Jobs Act that I referred to earlier is any of those items that have that lower schedule can actually be depreciated year one. So rather than taking 15 to 27.5 years to benefit from all of your depreciation, you get to do it right away. Which is super cool. So generally, you're seeing about a 60% bonus depreciation year one through that. And if you're interested in learning more about tax benefits, obviously, we always recommend that you reach out to a qualified tax professional because we are not tax professionals. Still not seeing any new questions. Just give it just a minute here, people. Good. Stop sharing my screen so I can see.
I think Brett, you did a great job. So no questions.
Thanks, Alpesh. You got any yourself that you want to ask on behalf of your investors?
Yeah, I think the cash flow you mentioned at end of 6 months after acquisition.
Yep.
And what are we anticipating like for year one cash flow?
So and I think Matt referred to this earlier, we have a few outstanding assumptions we need to lock in over the next few days, and we're going to be doing that through our final tenant interviews and locking in the business strategy. And with that, we'll be able to publish a true cash flow projection. What we like to say is if you invest 100,000, you can expect year one, you're going to get this, year two, you're going to get this. So you will know exactly what we expect your distribution to be. At this point, we didn't have enough of that locked in to feel comfortable sharing that. So that's something we'll share over email, and we can do a follow-up call with anybody that's interested.
Awesome. Okay. And the last question I had on the funding date, by when do we anticipate investors need to fund? If April 11th would be the closing date.
Yeah, so we're looking, so April 11th is that Monday. So we're looking for Friday the 8th for the funding deadline.
Okay, sounds good. Yeah.
Yeah, and Alpesh, actually, just real quick, wanted to come back to your question on the cash flow. So the way that the 8% preferred return works, I don't think I really explained this, but if we don't pay it, it's accrued. So for example, let's say that we go a whole 2 years and we never paid out a single dime for that 8%. That would accrue to be 8% per year. So now we owe you 16% on your investment, and we have to pay that out before we can pay anything else out. So we pay, if you invested $100,000, then the first money come back to you is your $16,000 preferred return at the end of 2 years. And then we would get to start catching up on like your capital distribution. So we could start paying back your $100,000 investment. But that kind of the cream at the top of that is that preferred return that gets accrued.
That's awesome. Thanks, Brian.
Yeah, thanks for the question, Alpesh. Okay, I think with that, we'll go ahead and wrap. I really appreciate everybody's time joining us. Again, we're going to go ahead and send out this webinar recording tomorrow, along with some of the notes and key slides that we'll have in there. But the full deck will be available for download through the email as well tomorrow. If you have any questions you want to reach out to me in advance, you've got my email, had it on the deck there. I'll go ahead and share it again here as we're all finishing up. But really appreciate your time. Sponsor team, thanks for the time presenting this and putting together. But I hope you all have a great night. Get to our email addresses here.
Thanks, Brett. Thanks, everyone.
Thanks, everyone.
Okay, and I'll stop the recording. Thanks again, all.